Before we discuss AI rally, boom, bubble, or just hype, an important disclaimer. Stock market returns are never guaranteed. But when we do the research properly, do the deep fundamental and technical analysis, we do get an edge in the market, but risk management cannot be ignored. Artificial intelligence or AI is everywhere. From phone assistant to stock market headlines, AI is being called the most powerful technology of our lifetime. But investors are asking a big question. Is this a real economic revolution or are we entering an AI bubble? Today, we will decode what's really driving the US stock markets. By the end of this video, you will understand why even fund managers who believe in AI are becoming more cautious. Let's begin. The AI boom story. Let's begin with how this AI boom started. In 2023, OpenAI's ChatGPT changed everything. Suddenly, every big tech company wanted to be part of AI race. Microsoft invested billions in cloud infrastructure. Google launched its own AI tools. Meta and Amazon announced huge data center spending. The result? New wave of excitement that AI will transform productivity, reshape industries, and drive the next phase of global growth. The stock prices of these companies jumped very fast. The Nasdaq 100 gained over 30% in just 1 year. Investors started to believe that AI would solve almost every business problem. The story sounds perfect: technology, innovation, and profits. But remember, every perfect story has another side too. The data behind the boom. Now let us look at what's really happening underneath. Today, just 7 large companies, often called Magnificent Seven, make up around 35% of entire basket of S&P 500 value. That means 1/3 of the US stock markets depend upon only a few giants. If we remove those 7 stocks, overall earnings growth in S&P 500 becomes then almost flat. So rally is not broad, it's narrow and concentrated. Take Nvidia, the biggest winner of the AI race. Its market value has added hundreds of billions of dollars this year alone. Corporates across the world are spending over $200 billion on AI chips and data centers in 2025. And here is the interesting part. Most of the money flowing into US ETFs automatically goes into same mega cap stocks because they have the highest weights. So passive investing keeps making the big even bigger. That is why I say this rally is less about all companies growing and more about a few companies dominating. Are bubble signs appearing? Now let's ask, are we seeing bubble type signals? Look at the valuations. Nvidia trades above 50 times its expected earning. The Nasdaq overall is around 28 times, much bigger than the historical averages. Retail investors are back in full swing. AI themed ETFs, AI related small cap stocks, even AI crypto tokens, all are in fashion. We also hear a familiar sentence. This time it's different. But we heard the same line in the year 2000 during dot-com bubble. The truth is, AI is real, but the profits from AI are still very small compared to the hype. Many companies are spending heavily to adopt AI, yet they don't earn much from it. Always remember one line. Bubbles are not born out of lies. They are born out of exaggerated truths. AI is a truth. The exaggeration is the speed at which the investors expect to change the world. What's actually driving markets higher? So if the profits are not the full reason, what else is pushing the US markets up? Number one, liquidity. Global money supplies is still very high. Investors expect Fed may cut rates even in 2026. So they are staying risk on. Number two is the buybacks. Big companies like Apple, Microsoft, Alphabet are buying back billions of their own shares. That reduces share supply and lifts the prices. ETF and passive flows. When investors buy an S&P 500 ETF, most of that money goes straight into these top 7 companies, automatically increasing their demand. Number 4, market psychology. Nobody wants to miss the next big thing. Fear of missing out or FOMO is stronger than the fear of loss. So the rally is not just about fundamentals, it is about flows, liquidity, and emotion. That is why you will often see markets rise even on mixed economic data, because the flow of money itself becomes the driver. The risk reward reality check. Now let us take the balanced view. If the bond yields keep rising, the valuation of the growth stocks will come under pressure. A small move from 4% to 5% in US 10-year treasury yields can reduce the future cash flow value sharply. At the same time, US government is facing shutdown issues that adds more uncertainty for investors. Corporate profits may grow slower in 2026 because the cost of borrowing and wage expenses remain high. Meanwhile, AI capital spending is rising very fast. That could narrow the margins for many tech firms. Outside the US, Asia and Europe are trading at much lower valuations. Some global funds are slowly diversifying away from US tech to emerging markets. So risk to reward balance is getting thinner. AI remains exciting, but the market may have priced in too much too soon. Conclusion. So finally, is this an AI boom or a bubble? The honest answer is a bit of both. It is genuinely technology revolution that could transform productivity. But the market has priced in as if every company will double its profit next year only. If you are a long-term investor, stay disciplined. Don't chase the hype. Wait for good valuations. If you are a short-term trader, ride the momentum, but always keep a plan for exit with a proper risk management. Remember, markets reward patience, not emotions. Understanding price behavior and psychology behind it is the key to survival in any market. To master that, watch our Zero to Hero series in my main channel, DK Sinha, a complete course on technical analysis and trading discipline. And as always, learning never stops with DK Sinha.
Let's start with this stock market 101 video.
Good idea. It covers the basics.
Yeah.
Yes.
And then maybe the common mistakes one.
Yes.
Yeah.
So we avoid those.